Hi there, welcome to Kneppy Invest. I thought since I do quite a few Appendix 4C or quarterly report videos, and I tend to focus on a select few companies, I thought I should expand my horizon and look at a few more companies that have released their Appendix 4C. And that endeavor starts with a company called AMA Group. And I would probably think many investors out there would consider this company a dog stock. Now, me personally, I don't consider any companies to be dog stocks because I think the term dog stock gets thrown around a little bit too much. In fact, I have heard some investors call high quality companies dog stocks simply because the share price has decreased from when they bought in the week before. So in today's video, I'm going to be focusing on AMA Group's March quarter Appendix 4C. And I think main reason I decided to look at AMA Group is because the share price dropped over 30% when they did release their quarterly report. So obviously the market hated the results for AMA Group. And sometimes when the share price drops by about 30% or over 30%, that does lead to a possible potential opportunity to buy into a company at better valuations. But then you might say, well, if it's dog stock, then it always remains a dog stock. And even if the share price drops 30%, it is not an opportunity. So let's decide whether AMA Group is a possible addition to our portfolios. AMA Group is a vehicle repair company. So if you maybe not destroy your car, but if you're in a crash, maybe you will use AMA Group services. And when I see the two words vehicle and repair put together, I automatically know this company exists on really tiny margins. And you can see that this company exists on really small, tiny, minuscule margins. When you just look at the amount of revenue and cash receipts this company generates on a quarterly and yearly basis. And we'll look at that later in the video. Now, this company listed on the ASX in August 2006 as another company called Allomac. Now, if I remember correctly, Allomac was a seller or distributor of vehicle parts. And then for some reason, over the past 10 or 15 years, the management decided to transition from that sort of business model to a vehicle repair business model. I'm not sure if there were any acquisitions involved in there, but they have made that transition. And you'll be able to see that when we look at the revenue history of this company, that for about 5 or 7 years, revenue was growing slowly. And then all of a sudden we saw a massive jump in revenue and then also a massive decrease in margins. And that's when they made that transition from being a seller and distributor of vehicle parts to being a vehicle repair company. The CEO is Carl Bison. And for those who are looking for companies with skin in the game, definitely not that here because Carl Bison, the CEO, only owns 0.08% of AMA Group. Now to two of the largest shareholders. And it's really interesting that these two institutions are quite well known. Australian Super owns 10.5% of AMA Group, and WH Soul Pattinson, a company I do respect quite deeply, own 2.6% of AMA Group. Now, there are quite a few companies that WH Soul Pattinson owns or has in their portfolio that I would probably never become a shareholder of, but it doesn't mean I can't respect WH Soul Pattinson. It's just interesting that they've decided that AMA Group fits within their portfolio. And the current market cap of AMA Group is $177 million. That's a share price of 16.5 cents. Now, the share price had dropped a lot on the back of the release of the Appendix 4C, and that share price was a few trading days ago. So have a look at what the share price is right now. So it might be a little bit different than 16.5 cents. And that market cap can be deceiving. So you might see that market cap, look at the revenue, look at the past profits and cash flow this company has had and think, well, this company is cheap. But this company also has a fair bit of debt, about $230 million of debt, which means the enterprise value of this company is closer to $400 million than $177 million. And in my opinion, enterprise value is a better indication of the true valuation of a company. Shares on issue, 1.07 billion. And this company has issued a lot of shares over the past 16 years because back when they listed as Alamac, this company had 84 million shares. So shares on issue have increased about 12, 13-fold over the past 13 years. Not the sort of thing you do want to see when you own shares in a company, because unless you partake in any sort of capital raising, you have been highly diluted over that time period. And the ticker code for this company could be anything else other than AMA. Now, I've already mentioned that when this company listed on the ASX as Alamac, they had a little bit of a different business model. And then they went into vehicle repairs. I'm not sure if they made acquisitions, quite a few acquisitions. And the increase in shares in issue probably does suggest they made a few acquisitions. And the way they paid for those acquisitions was by doing some capital raisings. And when you look at the revenue history for this company, you can see revenue, it did increase slowly between 2007 and 2015 from about $40 million to $90 million. Then all of a sudden, revenue started to increase quite significantly back in 2016. In fact, revenue went from $93 million to $920 million between 2015 and 2021. So you could say that increase in revenue is quite impressive. In fact, increasing revenue is one of the things I am looking for, but more accurately, I'm looking for revenue per share increases. So again, shares on issue for this company have increased significantly. So the revenue per share increase for AMA Group is not quite as impressive as this revenue graph shows. The other thing I've included in this particular slide is operating margins. So what they've gone and done over the past, back in 2015 or whatever it was, is they've transitioned from a higher operating margin company to a much lower operating margin company. So back between about 2007 and 2015, this company existed on operating margins of between about 14 and 18%. And then they made this transition. We saw revenue increase at a really great rate, but margins, operating margins came down significantly from that 14 to 18% range down to lower or less than 6-7%. In fact, in the last 3 years, operating margins have turned negative, which is understandable because this company is no longer profitable and they're burning through lots of cash. One of the reasons why AMA Group might be considered dog stock on the ASX is because not only is this company burning through a fair bit of cash, particularly in the past year, they're also highly unprofitable. In fact, in the past 3 financial years, they have made a loss of $70 million, $97 million, and then $144 million after being profitable between 2010 and 2019. The only other unprofitable year this company had was back in 2009. So that was definitely affected by the GFC. And it seems like the last 3 years, financial performance of this company has been affected by COVID-19. More than likely, this company is being affected by inflation, including the increasing in wages and also labor pressures. They can't find enough staff, and the staff they can find, they have to pay higher wages because of those labor pressures. Not only is this company been loss-making over the past 3 years, this company has gone from being operating cash flow positive between 2010 and 2021 to being operating cash flow negative by $28 million in 2022. And it seems like, based off their Appendix 4C, it's gotten only worse. Maybe I'm being a little bit harsh by saying things have only got worse for AMA Group, because in financial year 22, they burned through, what was it, $28 million in operating cash flow. For the first 9 months of financial year 23, they've only burned through $3.7 million in operational cash flow. And in this particular quarter, they're actually operating cash flow positive by $323,000. Now, you might laugh at that and say it's a small amount, but at least it's positive when they've been negative for the last, say, 18 months or so. Now, whenever I look at Appendix 4C, the first thing I always look at is cash receipts. Now, AMA Group generated $223 million of cash receipts in the March quarter, and $711 million of cash receipts for the first 9 months of the year. So again, this should prove to you that this company exists on really tiny margins. So even though they generated $223 million of receipts, they're only operating cash flow positive by $323,000. And for the 9 months, they're actually operating cash flow negative. So again, really tiny margins. $81 million they spent in staff costs in the quarter alone, and $254 million on staff costs during the first 9 months of the year. So they do have to hire or employ a lot of mechanics for their repairs. So again, labor cost is a significant cost for this business. So whenever you see wages rising, or they have a hard time at filling their positions in their mechanics, their locations, their repair service divisions, whatever you want to call it, they will have to increase their wages to attract new talent to the company. So this company is minusculely operating cash flow positive, but you also got to take into account investing and financing activities, because in the investing activities, this company spent $3.5 million on capital expenditure in the March quarter and $7.9 million of capital expenditure during the first 9 months of the year. So this company continually needs to spend a little bit more money each and every quarter on capital expenditure. And not only that, they also spent $7.6 million on the principal elements of lease payments and $21 million during the first 9 months, which makes sense because this company probably doesn't own their places where they do repairs, their mechanics, their areas of employment, that sort of thing. They have to spend money, they have to spend rent, and they have to spend that or pay that rent every single quarter, more than likely every single week or every single fortnight. And that adds up $21 million for the first 9 months of the year. So when you take all that into account, this company actually burned through $13 million in this one quarter. At the end of the quarter, this company only had $20.6 million of cash left. So that possibly means either this company will have to increase their debt or do another capital raising to increase the cash on hand if they continue to burn through this amount of cash on a quarterly basis. One part of the Appendix 4C I always have a glance at least a glance, is Section 7, financing facilities. Now, the majority of companies that do issue Appendix 4C have nothing here because they don't have debt. Well, when a company does have debt, it's very important to know how much debt they have, how much unused financing facilities they have, and the particulars of the debt. I have seen instances in the past where the interest rate on a financing facility for a small cap company is about 20%. That's a pretty high interest rate. And that's the reason why many companies, particularly very small companies, get in trouble if they have too much debt. So at the end of the March quarter, AMA Group had $232 million of debt and only $1.1 million of unused financing facilities, which means if they keep burning through the amount of cash they have over the past 18 months, they won't be able to use these financing facilities they already have. So either they have to draw up a new financing facility with some other lender or one of these lenders they have already, or again, maybe do a capital raising. Now, Section 7.6 is something I really like to look at each and every time I see a company that does have debt, because this gives us the particulars of their financing facilities, how much the financing facility is, the lender, and the interest rate. Sometimes they even give a maturity date and whether it's secured or unsecured. For instance, AMA Group has $182.5 million through about 7 or 8 lenders, which include ANZ, NAB, Bank of China, Bendigo Bank, First Commercial Bank, and Westpac. And the interest rate is BBSY, which I believe is bank bill swap rates, plus 415 basis points. Maturity date, October 2024, and it is secured. So interesting, this company has a lot of financing facilities with different lenders. And at this point in time, that debt amounts to $232 million. So that is a problem for me to see a company with debt greater than their market cap. That is a major red flag, and possibly why some people, some investors would consider this company as being a dog stock. When I first saw the market reaction to AMA Group's Appendix 4C, I was a little bit shocked because I didn't think the Appendix 4C itself was not that bad. And then I took a little bit of a deeper look at the Appendix 4C, and then I realized there was a profit downgrade, hidden, maybe not hidden, but definitely within the Appendix 4C. And if you do watch my videos on a pretty constant, consistent basis, you will know that my favorite type of announcement is a profit upgrade, because it is the most powerful type of news flow a company can release to the market. And on the flip side of that, the most negative, the most destructive announcement a company can release is a profit downgrade. And AMA Group did exactly that in their Appendix 4C. Now, they did give some guidance in relation to normalized post AASB 16 EBITDA, and their previous guidance was for it to be between 70 and 90 million dollars. Now they expect that normalized post AASB 16 EBITDA to be between 60 and 68 million. So it's a small decrease in their expectations, but any sort of decrease, any sort of profit downgrade will have a significant negative impact on the share price, as was seen with AMA Group's share price plunging 30 or over 30%. And the reasons behind this profit downgrade were as follows: margin compression, in fact, ongoing margin compression adverse to expectations. And the other thing they mentioned here is, even though there is this profit downgrade, the company expects to be operating cash flow positive for the second half of financial year 23. And we already know for the first quarter of the second half that they were operating cash flow positive. They also mentioned here excluding principal elements of leases, but they already exclude that when you look at the Appendix 4C. So they still expect to be operating cash flow positive, but more than likely they will be burning through more cash flow, more investing, and what's the other one? Financing cash flow. So that $20 million of cash they have on their books could be significantly lower at the end of the financial year. Within AMA Group's commentary, they give some reasons why this company is not performing right now, even though there is strong repair volume. And that strong repair volume has been adversely impacted by labor constraints. In particular, there's not enough people out there, experts out there, mechanics out there to fill the positions. In fact, they've mentioned here elevated lateral hiring activities as industry participants seek to fill vacancies. So it seems like all these repair companies, vehicle repair companies, are in competition with each other to fill their positions because there's not enough experts out there, not enough mechanics. So more than likely, these companies are looking overseas, and they're going to try to bring more overseas talent to fill these vacant positions. And I think that's exactly what AMA Group's doing. But because of these elevated lateral hiring activities, they have to spend more money to hire staff. And this company spends a lot of money on labor because they need a lot of mechanics to repair all the damaged vehicles. Let's have a look at the long-term chart for AMA Group. This is the monthly chart going all the way back to when Alamac listed on the ASX in 2006. A little bit of hype in this company when it first listed. Share price went to about $1, and then GFC significantly adversely affected this company. You can see the share price taking an absolute plunge during those 2 years, 2007 and 2008. But between about 2009 and 2020, just before the COVID-19 financial panic, share price of this company was in an uptrend. In fact, the share price went from about 5 cents to a high of $1.44. That's a nice return over an 11-year period. And unfortunately, then COVID-19 happened. And to be honest with you, this company has not recovered from that period. In fact, the share price has fallen from $1.44 down to 16 cents. And 16 cents, or around this level where the share price is right now, is a fairly significant support level. This is a level we saw the share price get during COVID-19 financial panic. And also the share price got to this level about a year ago, let's say 8 or 9 months ago. We saw a nice little rebound in the share price. Looked like the share price was trying to move into an uptrend, but after the debacle of this profit downgrade, the share price has moved back down to that strong support level. Now, the reason that it's support level is because it has been tested a couple of times over the past 3 years. And if it falls below 16 cents, that means the last time the share price would be this low was way back in 2012. So we're talking about at least a 10-year low in the share price. Now, the main question I have is whether AMA Group should be considered a dog stock. So based off what you have heard and seen in this video, would you concur that this company is a dog stock right now? Now, this company is experiencing some significant headwinds. If they can overcome these significant headwinds and become operating cash flow positive, profitable, free cash flow positive, maybe this company is looking quite enticing at these levels, because if they can get their profit back up to say $30-40 million a year, operating cash flow positive, $34 million, decrease their debt significantly, then a share price of 16.5 cents might look attractive. But there are a lot of questions, a lot of ifs there. So if you want to leave any of your thoughts in regards to AMA Group, you can just leave your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.